we index Social Security to the CPI, which I entitled the CP lie, while we actually inflate away the purchasing power of the currency at a much greater rate than we did before. That's precisely what we did in the decade of the 1970s, Paul. Over the decade of the 1970s, not coincidentally, the US dollar lost 75% of its purchasing power. And of interest to Kitco viewers who may not be as old as I and don't remember that, during that same period where the US dollar lost 75% of its purchasing power, the gold price ran from an admittedly price-controlled $35 an ounce up to $850 an ounce. I'm not, by the way, suggesting that from this level, the gold price rises 30-fold, but I am suggesting that there is a real correlation between the nominal gold price and the deterioration of the purchasing power of the US dollar. Precious metals throughout history have tended to do well when people were concerned about the maintenance of their purchasing power in other forms of fiat-denominated savings or investment products. Those concerns, I believe, currently are very well founded. It's important to note that while the moves in gold, as an example, have become more dramatic and gained more attention in the last 2 years, I would suggest to you that a gold bull market and conversely a bond bear market has been underway since the year 2000. In fact, Paul, as you and I have discussed, if you looked at the pricing of many items today that are alleged to be expensive, and if you thought about them in gold terms, you will decide that they're very cheap. Housing priced in gold is cheap. Insurance, healthcare, groceries, all those things priced in gold are cheap. And I think what you've seen in the last 2 years is the realization that the nominal price of gold, which is to say the US dollar price of gold or the Canadian dollar price of gold or the euro price of gold, was too cheap. The move that you saw in 2024 and 2025 was, I suspect, a catch-up for 20 years of gold's real worth, and by inference, silver's real worth, relative to fiat currencies, which was becoming worth less every quarter.
The US dollar's purchasing power is declining far faster than official inflation figures suggest. While government rates may appear sufficient, real losses in value likely reach 8 to 10% annually. As long as savings products yield below this erosion, gold and silver will outperform fiat instruments. Forecasts suggest that over the next decade, the dollar could lose up to 75% of its real value. In this scenario, gold is not just a hedge. It becomes a necessary asset to preserve wealth. Historical parallels, including the 1970s, highlight gold's ability to mirror currency devaluation and protect purchasing power.
It's my belief that as long as you experience compound negative interest rates in fiat instruments, that the gold price will do well. If all your listeners believe that the rate of deterioration of the US dollar actually conforms to the CPI, which is to say 2.7, 2.8, 2.9% annual deterioration of the dollar, then the current interest rates on US savings products is adequate. If you believe, like I believe, that the purchasing power of the US dollar is really declining by 8 to 10% a year, then the current 4% yield on treasuries is very, very, very insufficient. My personal belief is that negative real interest rates on savings products will continue for a substantial period of time. My belief, further, is that as a consequence in the US of debt and deficits, that the US dollar's real purchasing power declines by 75% over 10 years. That would suggest to me that the gold and silver market has real legs. In other words, that gold will maintain its purchasing power, which means that it will gain fairly rapidly against the nominal yields experienced in fiat currency denominated instruments. It wouldn't surprise me, Paul, if the increase in the nominal gold price mirrored the deterioration in the purchasing power of the US dollar over the next 10 years. Don't make this a Kitco headline, but I think there's a possibility of a 3 or 4-fold nominal increase in the gold price over 10 years as a consequence of the 75% deterioration in the purchasing power of the US dollar, which I expect over that period of time.
America's financial obligations are staggering. On-balance sheet debt exceeds $39 trillion, already surpassing GDP, and grows $2 to $3 trillion annually. Off-balance sheet liabilities, Medicare, Social Security, federal pensions, add another $120 trillion combined. The federal government faces $159 trillion in obligations, barely offset by the $6 trillion Fed balance sheet. Private wealth in the U.S. totals $167 trillion, leaving an alarming margin. With deficits projected to grow $6 trillion yearly, the government is likely to reduce obligations through inflation, similar to the 1970s. This dynamic directly supports precious metals, reinforcing their role as a wealth-preserving hedge amid structural fiscal pressures.
I don't know. I'll tell you, looking at 15 years, I suspect for people who pay attention, the world will be much nicer than it is today. But we have to get from here to there. And arithmetically, I'm not sure how that plays out. Let's do some numbers, Paul, to put this in perspective. The on-balance sheet liabilities of the U.S. government, which is to say what the U.S. government owes to bondholders, is approximately $39 trillion. That number itself is almost 120% of gross domestic product. And that number, that $39 trillion, will this year, according to the Congressional Budget Office, grow by between $2 or $3 trillion a year. In other words, we're not making this negative pile smaller, we're making it larger. But a much bigger problem, Paul, a much bigger problem is the net present value of unfunded entitlement liabilities, Medicare, Medicaid, Social Security, federal pensions, military pensions. The net present value of that, not the nominal value, the net present value of unfunded promises exceeds $120 trillion. Now, let's add 39 trillion to 120 trillion and get the total liabilities of the U.S. government. Not state government, not local government, not corporate debt, not individual debt, just at the federal level. That number is $159 trillion. Against that, you can offset the Fed's own balance sheet of $6 trillion, $6.5 trillion. So let's bring the number down to a more manageable $155 trillion. And let's juxtapose that against the aggregate private net worth of Americans, what we purport to use to service the debt. That number, according to the IRS, is $167 trillion. What that means is that the margin between what we have and what we owe is distressingly small. And between on and off balance sheet deficits, growing between $4 and $6 trillion per year. That math doesn't math. My suspicion is the way that we pretend to honor our obligations, if they are obligations, to entitlement beneficiaries, is that over 10 years, we inflate away the net present value of the liability. In other words,
history provides compelling lessons. During the 1970s, the dollar lost 75% of its purchasing power, while gold surged from $35 to $850 an ounce, even under price controls. The correlation between currency erosion and gold appreciation remains strong. Looking forward, a similar relationship could drive gold prices significantly higher over the next decade. While some suggest extreme spikes, realistic scenarios anticipate multi-fold growth tied directly to the weakening dollar. Investors who understand this historical precedent are positioned to benefit, particularly when traditional financial instruments continue to deliver negative real returns.
We index Social Security to the CPI, which I entitled the CP lie, while we actually inflate away the purchasing power of the currency at a much greater rate than we did before. That's precisely what we did in the decade of the 1970s, Paul. Over the decade of the 1970s, not coincidentally, the US dollar lost 75% of its purchasing power. And of interest to Kitco viewers who may not be as old as I and don't remember that, during that same period where the US dollar lost 75% of its purchasing power, the gold price ran from an admittedly price-controlled $35 an ounce up to $850 an ounce. I'm not, by the way, suggesting that from this level, the gold price rises 30-fold, but I am suggesting that there is a real correlation between the nominal gold price and the deterioration of the purchasing power of the US dollar. I need to interrupt you for a second. About half of those capitas aren't taxpayers. That's the real problem. Some left-leaning viewers to this, assuming you have some left-leaning viewers, might say, well, I have an answer. Tax the billionaires. The problem with that is that the aggregate net worth of America's billionaires is somewhat below $7 trillion. So if rather than increasing their taxes, you stole all of their net worth, you solved the problem for about 18 months. Make the rich pay their fair share. The top 1% of taxpayers pays 42% of the tax. If you make the rich pay their fair share, when might they expect their rebate? And what will you use for money?
Savvy investors are learning that gold and silver equities can amplify gains beyond bullion. While silver offers speculative upside, high-quality silver stocks historically deliver 2 to 2.5 times leverage over the metal price. By focusing on well-valued mining equities, investors can exploit market inefficiencies and margin expansions, especially as metals hold or rise. Knowledge of asset valuation, recycling ratios, and company fundamentals provides a competitive advantage. Investors with expertise can capture outsized returns compared to generalists, particularly in markets where sentiment and misinformation distort pricing. This strategy requires patience, research, and disciplined execution.
It has been difficult for me since at least 2020 to understand why more people weren't in the mining space. The setup looked to me like a slam dunk. You know, Paul, you and I exist in the gold ecosystem. You and I have participated and are excited about the gold price. Many generalist investors still can't spell gold. Certainly, those same generalist investors are more interested in it at 4,500 than they were at 2,000. That's human nature. But let's get back to your point. When I look at consensus earnings estimates from Bay Street or Wall Street, I'm struck by the fact that many of the analysts are predicating their assumptions on $3,200 or $3,300 or $3,400 gold. It would seem like a real recipe for an earnings surprise when the estimate is predicated on a $3,300 gold price, and the gold gets sold for $4,500. My suspicion is that the companies are really going to have some barn burner earnings and cash flow reports in the quarter. The second point I would make to you, Paul, and you'll remember us making the point at the Natural Resources Investment Symposium, when ultimately over time, equity prices reflect the net present value of cash generating assets. If you use a $4,500 gold price to use a net asset value or net present value calculation, as opposed to a $3,000 number, it isn't merely that the metals price is materially higher. It's that the margin is expanding much more rapidly than the gold price is. And the net present value calculations of these companies expand almost geometrically at higher gold prices. This doesn't affect the market in the 2-week time frame or the 3-week time frame, but it really truly drives the market over the 2-year time frame or the 3-year time frame.
The macroeconomic environment favors those who understand structural risks. Inflation, negative real yields, and mounting federal debt create conditions where precious metals thrive. By diversifying between physical bullion, liquid assets, and carefully selected mining equities, investors can protect wealth while capturing growth potential. Silver remains a speculative play, while gold provides long-term stability. Historical patterns combined with current monetary policies suggest that disciplined positioning in metals and equities can generate returns that far exceed conventional investments. For those willing to educate themselves and remain patient, this is a unique opportunity to outcompete the average investor.
Well, I think that's right. I think, unfortunately, many investors and speculators' technique, including some institutional speculators, is got a hunch, bet a bunch. And those people haven't taken the time to understand really what makes companies more valuable and to understand the interplay between price and margin and value and share price. So much the better for the Kitco viewer who takes the time to educate him or herself and can, as a consequence, outcompete the general public. The decision was personal. Physical silver occupied a speculative portion of my portfolio. As you and I have discussed, Paul, I save in gold. I maintain liquidity in very short-term US dollar denominated instruments. And I speculated on silver. Back in the days when silver was about $20 an ounce, it received real social media hate, and I love hate. So I bought some silver, thinking that as the hate dissipated that the price would go up. Turns out I was right. And I decided, given that silver was for me a speculative asset, that it had accomplished all I needed it to accomplish. As you know, Paul, I write myself a little memo whenever I buy anything, and I refresh my memory as to that memo about quarterly. And I remember buying silver at $20 an ounce, saying that I thought there was a probability that it would go to 50 when the hate subsided. Well, I was wrong. I went to 75. Suffice it to say, physical silver gave me everything I wanted. The second thing that occurred to me was if the silver price could hold at this level for 6 months, that the high-quality silver stocks would re-rate. The silver stocks generally in prior bull markets have generated 2 to 2.5 times leverage over the silver price, and they have merely kept pace this year. So if I believed that the silver price could hold but didn't have to go up, what that meant was that the silver stocks would re-rate much faster than silver. If the silver price holds even for a year, had I maintained my holdings in silver, I would be flat for a year. But my suspicion is that the silver stocks, a basket of silver stocks, would be up by between 50 and 100%. So I decided that rather than speculate on silver, I would speculate on the silver stocks. I also believe that I have durable competitive advantages against other speculators in the silver stocks. I know how to value them. I know how to analyze them. I know what recycle ratio is. I know what the important characteristics of a high-quality silver stocks are, and many investors that I compete against don't. So that gives me a competitive advantage in the market that I didn't enjoy with the bullion.